Success in trading is not a secret. It is a skill. And like every skill, it can be learned, practiced, and mastered. In this book, Mark Minervini shares the mindset, discipline, and precise methods that helped him transform from an ordinary trader into one of America's most consistent stock market winners. His message is simple. Trading success starts not with the market, but with the mind. Mark was not born into wealth. He began with small trades, countless failures, and many sleepless nights. But what separated him from others was his determination to learn from every mistake. Over time, he realized that the market rewards preparation, focus, and emotional control far more than luck. This book is his attempt to hand over those lessons, the same principles that helped him win the U.S. investing championship with over 155% return in a single year. This is not a book about magical indicators or secret formulas. It is about thinking differently. It is about building habits that make you calm when others panic, confident when others doubt, and patient when others rush. Mark believes that trading is not a guessing game. It is a performance sport where only those who train their minds and systems can stay on top. The book is divided into 4 parts. Each part takes you deeper into the world of high-performance trading. The first part focuses on the mindset, how champions think, prepare, and build unshakable confidence. Without the right mindset, even the best strategy fails. The second part takes you into the trading process, where Mark explains how to find great opportunities and manage risk like a professional. The third part dives into advanced methods, such as identifying superperformance stocks and mastering the volatility contraction pattern. Finally, the fourth part takes you into the inner game, teaching how to stay disciplined, handle setbacks, and keep performing at your peak even after losses. Mark Minervini's philosophy is clear. The stock market does not care about your opinions, your feelings, or your hopes. It rewards those who are prepared and disciplined. It punishes those who act emotionally. If you wish to win, you must train your mind to think like a champion before you ever place a single trade. And that journey begins now. Part 1. Developing the mindset of a champion. Every successful trader begins not with charts or strategies, but with a mental transformation. The market is a battlefield of emotions: fear, greed, hope, and doubt. To survive and win, one must first master the mind before mastering the trade. Mark Minervini opens this part by explaining that trading success is built on psychological strength, not just technical knowledge. He reminds us that most traders lose not because they lack information, but because they cannot control their reactions. The ability to think clearly under pressure, to follow a plan when emotions scream otherwise, is what separates a professional from an amateur. Mark calls this developing the mindset of a champion. This part teaches that the road to becoming a champion trader begins with awareness. Awareness of your thoughts, your fears, and your habits. You learn that your biggest opponent is not the market, but yourself. Winning is about breaking the old patterns of hesitation, overconfidence, and impatience. Mark compares trading to a performance sport. Just as an athlete trains daily, a trader must train the mind through discipline and repetition. You must believe in your method, prepare thoroughly, and stay consistent even when results fluctuate. Confidence comes from preparation, not from prediction. Before diving into the mechanics of trading, Mark insists that every trader must first build a solid mental foundation. Without it, strategies collapse under emotional pressure. With it, even a simple system can produce extraordinary results. And so, the journey to thinking and trading like a champion begins where all success stories begin, inside your own mind. Now we move to the first essential lesson in this transformation. It's all in your head. Chapter 1. It's all in your head. Success in trading begins in the mind. The market is not your enemy. Your own thoughts are. Mark Minervini emphasizes that the most important skill a trader can develop is mental mastery. Every decision, every reaction, and every trade is filtered through your beliefs. If you believe trading is gambling, you will act like a gambler. If you believe it is luck-based, you will wait for chance. But if you believe trading is a skill that can be learned and refined, you will begin to behave like a professional athlete, disciplined, focused, and persistent. Mark shares his personal journey to illustrate this point. Early in his trading career, he blamed losses on the market, the news, or timing. Each setback reinforced his fear and frustration. It took years for him to realize that the market was neutral. It was his mindset that created losses. This was a turning point. He understood that to change his results, he had to change his thoughts first. Your thoughts shape your reality in trading. Constantly focusing on losing breeds fear and hesitation, while focusing on learning and growth builds confidence and resilience. The mind must be trained daily, like a muscle. Preparation, practice, and self-discipline are as crucial as analyzing charts and financial statements. Emotional control is the true foundation of consistent trading performance. Many traders fall into the trap of chasing quick profits. They are driven by greed and impatience, which cloud judgment. Champions focus on process over outcome. They do not obsess over making money. They obsess over mastering their craft. Profits follow naturally when skill, discipline, and preparation align. Mark introduces a core principle. You become what you believe about yourself. Negative self-talk, thoughts like, I am unlucky, or I will fail, becomes self-fulfilling. Conversely, believing I can learn, I can improve, and I will follow my plan rewires your behavior and improves performance. Your results in the market are a reflection of your inner dialogue. Taking responsibility is essential. Every loss, missed opportunity, or mistake is a reflection of your decisions. Blaming the market only keeps you trapped as a victim. Owning your actions gives you power. Responsibility transforms fear into focus, hesitation into decisiveness, and reactive behavior into strategic action. Mark compares this transformation to rewiring the brain. Just as athletes train their bodies, traders must train their minds. Self-awareness, patience, and emotional neutrality are crucial. Fear can make you sell too early. Greed can make you buy too late. Champions remain calm, confident, and objective regardless of market conditions. Preparation enhances mental clarity. The more prepared you are, the calmer you become under pressure. Calmness allows clear thinking, and clear thinking leads to better decisions. This is the edge that separates consistent winners from emotional traders who react impulsively. By the end of this chapter, one truth is clear. To think and trade like a champion, you must master your mind. Transform self-doubt into discipline, fear into focus, and frustration into fuel for growth. The market will always test you, but how you respond determines your results. Mental mastery is the first step toward consistent profitability, and it sets the stage for understanding trading as a performance sport. With this foundation laid, the next step is to see trading not as a game of chance, but as a disciplined, high-performance activity, where preparation, focus, and execution determine success. That journey begins in the next chapter. Chapter 2. Trading is a performance sport. Trading is not a hobby, a pastime, or a guessing game. Mark Minervini insists that trading is a performance sport. Just like an athlete on the field, a trader competes against the market every day, and only those who prepare, practice, and perform consistently can succeed. Knowledge alone is not enough. Understanding charts, trends, and numbers does not guarantee profits. What separates champions from amateurs is the ability to perform under pressure, maintain discipline, and stick to a plan. Mark emphasizes that every trade is a test of skill, patience, and emotional control. In sports, athletes train for years to perfect their techniques and reactions. In trading, mental strength and preparation play the same role. You must train yourself to stay calm when the market moves unpredictably, to resist the temptation of chasing profits, and to act only when the opportunity meets your criteria. Performance is about execution, not just ideas. He introduces the idea of the trading arena. Every market day presents challenges, volatility, uncertainty, and sudden reversals. Traders who see these moments as threats react emotionally and make mistakes. Champions, however, view them as opportunities to execute their plan flawlessly. Success comes from preparation, not luck. The more prepared you are, the more confidently you can act, and the better your results will be. Mark also explains that performance requires a balance between aggression and discipline. Just like a professional athlete who times every move precisely, a trader must know when to act and when to wait. Patience is as critical as courage. Jumping into trades impulsively leads to losses, while waiting for the right setup and entering with precision creates an advantage. One of the key lessons in this chapter is that trading requires a structured routine. Athletes have training schedules, practice drills, and performance reviews. Traders must approach their work the same way. Pre-market preparation, reviewing past trades, studying charts, and analyzing market conditions are all part of building performance consistency. Daily practice strengthens decision-making and reduces emotional errors. Mark also addresses the psychological challenges of trading. Pressure, fear, and stress are constant companions. A trader can be technically correct, but fail if fear prevents execution or greed overrides strategy. Learning to control emotions, maintain focus, and act decisively under stress is what creates consistent winners. Mental toughness, not intelligence, is the differentiator. He highlights the importance of confidence built through preparation. Confidence is not arrogance. It comes from knowing your plan works and trusting your analysis. When you combine preparation with discipline, you achieve consistency, the hallmark of a champion trader. Finally, Mark makes the connection between mindset and performance clear. A great strategy executed poorly is worthless. A mediocre strategy executed flawlessly with discipline and emotional control can be highly profitable. Trading success depends on thinking like a champion, preparing like a champion, and performing like a champion every day. With the performance mindset established, the next step is understanding the value of preparation. In trading, as in sports, champions win before the competition begins. Preparation sets the stage for confident decisions, precise entries, and controlled risk. Next, we move into the chapter that builds on this principle. Chapter 3. Preparation is everything. Success in trading does not happen by chance. Mark Minervini emphasizes that preparation is the foundation upon which all winning trades are built. Just like an athlete studies plays, practices drills, and visualizes performance before a game, a trader must prepare meticulously before entering the market. Without preparation, even the best strategy can fail under pressure. Preparation starts with understanding the market environment. Mark explains that the market is dynamic and constantly changing. Patterns that worked in the past may not work today. A champion trader studies trends, identifies high-probability setups, and adapts strategies to current conditions. Preparation is not passive. It is active engagement with information, analysis, and foresight. He introduces the concept of a pre-trade routine. Before every trading day, a champion reviews market news, charts, and stock behavior. This process builds clarity and reduces emotional reactions. Knowing what to expect helps the trader remain calm when the market moves unpredictably. Preparation transforms fear into focus and uncertainty into actionable insight. Mark also highlights the importance of studying past trades. Champions analyze both winning and losing trades to extract lessons. Why did a trade succeed? Why did it fail? This reflection builds experience faster than trial and error alone. Preparation is about accumulating knowledge and turning it into a repeatable process. Another crucial aspect is defining criteria for every trade. Champions do not enter the market on a whim or follow tips blindly. They create strict rules for entry, exit, and risk management. By defining these parameters ahead of time, they remove guesswork and reduce emotional interference. Preparation is the act of creating a roadmap for success, so decisions during market hours are clear and confident. Mark stresses that preparation also includes mental readiness. A trader must be emotionally and psychologically equipped to handle both wins and losses. Markets test patience, discipline, and emotional resilience. Preparation builds confidence because when a trader knows the plan is sound, they can execute it without hesitation. He compares trading preparation to training for an athletic competition. Just as a runner does not start a race without stretching, pacing, and strategy, A trader should not place a trade without studying charts, evaluating risk, and understanding market context. Skipping preparation increases the likelihood of mistakes, impulsive decisions, and losses. Mark also points out that preparation is ongoing. A single day of study or a single review is not enough. Champions engage in continuous learning, adapting to new market conditions, refining their strategies, and improving their mental performance. Consistency in preparation translates into consistency in results. Finally, preparation is what separates consistent traders from gamblers. Those who act without preparation rely on luck and chance. Those who prepare systematically create an edge. They know when to act, when to wait, and how to manage risk. Preparation gives the trader control in an environment where most feel powerless. In essence, preparation is the bridge between knowledge and action. It turns analysis into execution, strategy into results, and potential into performance. When a trader is fully prepared, they approach every opportunity with clarity, confidence, and discipline. Once preparation is mastered, the next step is cultivating belief, confidence, and consistency. Without belief in your plan, preparation alone cannot sustain performance. That journey begins in the next chapter. Chapter 4: Belief, Confidence, and Consistency. Preparation is essential, but it alone cannot make a champion trader. Mark Minervini emphasizes that belief and confidence are the forces that turn preparation into action. Without belief in yourself, your strategy, and your plan, even the most thorough preparation will falter when the market challenges you. Confidence allows you to act decisively, while consistency ensures that you repeat winning behaviors over and over until they become second nature. Mark explains that belief is not blind optimism. It is rooted in preparation, knowledge, and experience. A trader who has studied charts, identified high-probability setups, and developed a disciplined routine knows that their plan works. This understanding creates a deep sense of belief, a mental certainty that when the conditions are right, success is likely. Belief transforms hesitation into decisiveness and doubt into action. Confidence is the natural outcome of belief reinforced by repeated success. Mark highlights that confidence is fragile if it is based solely on short-term wins. Real confidence comes from trusting the process, not the outcome of a single trade. When a trader follows a proven plan with discipline, confidence grows because the results become predictable over time. Emotional control and self-trust are the hallmarks of this state. Consistency is the third pillar. Even the most skilled trader cannot achieve long-term success without repeating their best practices daily. Champions do not rely on luck or occasional brilliance. They create patterns of behavior that lead to predictable results. Consistency is about showing up prepared, executing the plan, managing risk, and maintaining discipline day after day. It is the habit of performing at a high level regardless of market conditions. Mark warns that many traders sabotage themselves by letting emotions dictate their actions. Fear can prevent entry into a promising trade, while greed can cause overtrading or excessive risk. Belief and confidence, built on preparation, counteract these destructive impulses. They allow a trader to remain objective, disciplined, and focused, even when the market moves unpredictably. He also emphasizes the importance of self-awareness. A trader must recognize patterns of behavior that undermine success, such as second-guessing trades, abandoning strategies midstream, or overreacting to market noise. By identifying and correcting these tendencies, a trader strengthens confidence and consistency. Mark gives practical guidance on building these qualities. First, maintain a trading journal. Record every trade, noting the rationale, emotions, and outcome. Review the journal regularly to reinforce successful behaviors and learn from mistakes. Second, follow a structured routine. Confidence grows when you know exactly what steps to take each day. Third, set realistic goals. Unrealistic expectations breed frustration and doubt, while achievable milestones reinforce belief in your abilities. He reminds traders that belief, confidence, and consistency are interconnected. Belief fuels confidence. Confidence allows disciplined action. discipline leads to consistent performance. Together, they create a psychological environment where a trader can operate at peak potential. By mastering these qualities, a trader develops the mental edge needed to thrive in the market. Emotional stability and self-trust become natural, allowing one to execute strategies without hesitation and stay resilient during setbacks. Once a trader has cultivated belief, confidence, and consistency, the next challenge is to identify and break habits that undermine performance. Old patterns of behavior can quietly erode gains, no matter how skilled or prepared a trader is. That critical step begins in the next chapter. Chapter 5. Breaking Bad Habits. Even the most prepared and confident trader can fail if destructive habits go unchecked. Mark Minervini stresses that trading is as much about eliminating weaknesses as it is about developing strengths. Bad habits, such as impulsive buying, holding on to losing trades, or overtrading, can quietly destroy profits. Champions identify and remove these patterns before they have a chance to undermine performance. Mark begins by explaining that most bad habits develop over time, often without conscious awareness. Emotional reactions, shortcuts, and repeated mistakes become automatic behaviors. Traders may not realize they are sabotaging themselves because these patterns feel familiar or comfortable. Recognizing them requires self-awareness and honesty. One common habit is reacting to fear. Fear can manifest in many ways: selling too early, exiting trades prematurely, or avoiding high-probability setups. Mark explains that fear is natural but must be controlled. Champions learn to observe fear without letting it dictate actions. They understand that disciplined adherence to a plan outweighs emotional impulses. Greed is another destructive habit. Chasing profits, over-leveraging, or holding positions too long can turn gains into losses. Minervini emphasizes that greed is often disguised as ambition. Successful traders distinguish between strategic opportunity and emotional desire. They enter trades only when the setup aligns with their rules and exit when risk thresholds are reached. Mark also highlights the danger of indecision. Many traders hesitate to act, second-guess themselves, or constantly adjust strategies. Indecision wastes time and causes missed opportunities. The antidote is preparation and confidence. When a trader has studied the market, followed a tested plan, and developed self-belief, decisions become decisive rather than reactive. Overtrading is another bad habit that erodes profits. Trading too frequently without clear setups increases exposure to risk and emotional strain. Champions limit trades to high-quality opportunities, respecting risk management and their own mental capacity. Less is often more in trading, and disciplined restraint is a hallmark of top performers. Mark provides strategies to break these habits. First, identify patterns by maintaining a detailed trading journal. Record not only results, but emotional states, reasons for entry and exit, and deviations from the plan. Over time, this journal reveals repeated behaviors that harm performance. Second, establish strict rules for every trade, including risk limits, entry points, and exit strategies. Rules act as a safety net against impulsive actions. He also emphasizes replacing bad habits with constructive ones. For example, instead of reacting to fear, a trader can pause and evaluate the trade objectively. Instead of chasing profits, they can wait for high-probability setups. Habits form through repetition, so consistently practicing good behaviors eventually rewires the mind. Mindset work is equally important. Traders must confront self-doubt, negative thinking, and emotional triggers. Techniques such as visualization, mental rehearsal, and affirmations can help reprogram automatic responses. Champions train their minds to respond with discipline rather than instinctive emotion. Finally, Mark notes that breaking bad habits is a continuous process. Markets change, stress increases, and old patterns can resurface. Champions remain vigilant, self-aware, and committed to improvement. By eliminating destructive behaviors and reinforcing productive routines, traders gain the clarity, confidence, and discipline needed to perform consistently. Breaking bad habits clears the path for reliable execution. Once a trader masters their mindset, they can focus on the technical and strategic aspects of trading. That transition leads naturally into Part 2, the trading process where preparation meets action. Part 2, the trading process. With the mindset of a champion firmly in place, the next step is applying it to the market. Part 2 focuses on the trading process, the methods, strategies, and systems that turn preparation and mental strength into consistent results. Mark Minervini emphasizes that trading is not about luck or intuition. It is about a disciplined approach to finding high-probability opportunities and managing risk with precision. In this part, the abstract principles of mindset meet practical execution. You have learned how to control fear, build confidence, and break destructive habits. Now, you will learn how to act. This involves identifying the right stocks, timing entries perfectly, controlling losses, and making calculated decisions based on proven strategies. Success in trading is a combination of a champion's mind and a repeatable process. Mark introduces the core idea of this section. The market rewards preparation and punishes impulse. Every trade should be planned, deliberate, and backed by a strategy. Random actions or chasing hot tips are the behaviors of amateurs. The champion trader studies, analyzes, and follows a process that has been tested and refined over time. This part will cover essential components of the trading process. You will learn about strategies that consistently work in real-world conditions, the SEPA method for identifying precise entry points, timing tactics, and managing risk mathematically. You will also discover how to handle market volatility while keeping losses tightly controlled. Mark emphasizes that understanding the process is not enough. Execution is where the results appear. Preparation, mindset, and knowledge create opportunities, but disciplined application of the process is what turns them into profits. In other words, you must combine a champion's mindset with a champion's method. By the end of this part, you will know how to consistently identify high-probability trades, manage risk like a professional, and execute with precision even under market pressure. Every step will reinforce the lessons from Part 1: belief, confidence, consistency, and discipline, while adding practical tools to act on those principles. With this foundation, we now move to the first critical element of the trading process: understanding trading strategies that work. Chapter 6: Trading Strategies That Work. Trading successfully is not about guesswork or following tips. Mark Minervini stresses that a champion trader relies on strategies that have been tested and proven to work in real market conditions. The key is not to chase every opportunity, but to focus on setups that provide a clear edge. Strategies are the bridge between preparation and execution, turning knowledge into measurable results. Mark begins by explaining that successful trading strategies combine two critical elements: the identification of high-potential stocks and precise timing of entries and exits. A trader must first find stocks with strong fundamentals and technical strength. These are stocks that show consistent earnings growth, increasing sales, and leadership in their industry. The best setups are those where fundamentals and price action align, giving a high probability of significant upward movement. He emphasizes that not all strategies are created equal. Some methods work in specific market conditions, but fail in others. A champion trader tests strategies rigorously and adapts them to different environments. Flexibility and adaptability are essential. What matters most is finding patterns that consistently produce profitable trades while limiting risk. Mark introduces the concept of high-probability setups. These are chart patterns, price behaviors, or specific market conditions that historically precede strong performance. Examples include base formations, consolidation patterns, and volatility contraction setups. Recognizing these patterns allows a trader to anticipate price movement with greater accuracy. The goal is to enter trades where the probability of success is heavily weighted in your favor. Risk management is integrated into every strategy. Mark explains that even the best setups can fail, so it is essential to control losses. Each trade must have a defined stop-loss level, a clear exit plan, and position sizing that protects capital. Winning strategies are those that deliver more reward than risk while ensuring that no single trade can significantly damage the overall portfolio. Discipline in following a strategy, is as important as selecting the right one. Many traders fail because they deviate from their plan due to fear or greed. Champions stick to their rules even when the market tests their patience. Consistency in applying a strategy compounds results over time, turning small, disciplined gains into substantial profits. Mark also notes the importance of simplicity. Complex strategies with too many variables can lead to confusion and hesitation. The best strategies are often straightforward. Identify a high probability setup, define entry and exit points, manage risk, and execute with discipline. Overcomplication increases the chance of mistakes, while clarity and focus enhance performance. He advises traders to continually refine and adapt strategies based on market conditions and personal experience. By tracking results, studying patterns, and learning from both wins and losses, traders improve their edge over time. Every trade becomes a learning opportunity, reinforcing the process and building confidence. Finally, Mark reminds that strategies alone are not enough. They must be combined with mindset, preparation, and emotional control. A high probability setup executed with hesitation or emotional interference rarely produces consistent results. The synergy of a champion's mind and a tested strategy is what separates consistent winners from the majority of traders who struggle. With an understanding of strategies that work, the next step is learning a method to pinpoint exact entry points with precision. This leads directly into the next chapter. Chapter 7. The SEPA Strategy. Specific Entry Point Analysis. Identifying a great stock is only half the battle. The other half is knowing exactly when to enter. Mark Minervini introduces the SEPA strategy, Specific Entry Point Analysis, as the framework that allows traders to pinpoint precise moments to act with confidence. SEPA is not about guessing or following trends blindly. It is about disciplined, rules-based entries that maximize the potential for success while minimizing risk. Mark explains that SEPA is built on the principle of high probability setups. Not every stock that looks strong is ready for purchase. Champions wait for the moment when the technical pattern aligns perfectly with market conditions and fundamentals. The right entry point is where the probability of upward movement is highest and the risk of loss is controlled. SEPA provides the method to identify that moment. The strategy begins with base patterns. A base is a period where a stock consolidates after a prior move, forming a foundation for the next potential surge. Bases can take different shapes: cup and handle, flat base, or tight consolidations. But the key is that they represent stability and accumulation. SEPA teaches traders to recognize when a stock is completing its base and preparing for a breakout. Mark emphasizes the importance of price action within the base. He instructs traders to focus on patterns of volatility contraction. As a stock tightens within its base, volatility decreases, signaling that selling pressure is exhausted and buyers are accumulating quietly. This contraction sets up a powerful potential move once the stock breaks out. Precision in spotting this pattern is the essence of SEPA. Volume is another critical factor. A SEPA entry is confirmed not only by the price pattern, but also by an increase in volume on the breakout. Volume reflects market conviction. When a stock moves higher on rising volume after a base, it shows that institutional buyers are supporting the move, increasing the probability of sustained gains. Champions use this signal as part of their timing criteria. Risk control is integrated into every SEPA trade. Mark advises placing stop-loss levels below the base or key support levels. The smaller the distance between entry and stop-loss, the lower the risk. By combining precise entry points with defined risk, traders achieve a favorable reward-to-risk ratio. This disciplined approach protects capital and allows for repeated opportunities without jeopardizing the portfolio. Mark also discusses patience. SEPA requires waiting for the perfect setup. Impulsive entry or forcing trades before the criteria are met often leads to losses. Champions understand that missing a trade is far better than entering prematurely. They wait for confirmation, ensuring that each trade aligns with the rules of probability. Another important element is the mental clarity SEPA provides. By having specific criteria for entry, traders reduce emotional decision-making. The plan is clear, and execution becomes automatic. This clarity reinforces confidence and consistency, two essential traits of high-performance trading. Finally, Mark reminds traders that SEPA is not a rigid system, but a framework. It is adaptable to different market conditions, sectors, and individual trading styles. The goal is to combine technical precision with fundamental insight, creating an objective, repeatable process. Once traders master the SEPA method, they can move beyond identification to timing. The next critical skill is knowing exactly when to buy, how to recognize optimal points, and how to execute trades with precision and confidence. This prepares us for the next chapter. Chapter 8, Timing the Trade, Buy Points and Entry Tactics. Finding a strong stock with the SEPA method is just the beginning. Mark Minervini emphasizes that timing is the difference between a good trade and a great one. Entering at the right moment maximizes gains and minimizes risk, while entering too early or too late can turn a promising opportunity into a loss. Precision in timing is what separates consistent winners from those who struggle, despite having a solid strategy. Mark explains that every stock has a natural rhythm. After building a base, it reaches a point where buying pressure overtakes selling pressure. This is the ideal buy point. SEPA teaches traders to recognize subtle signs in price action, volume, and market context that indicate this tipping point. Entering at the top of the base or on a minor breakout ensures that the risk is limited and the upside potential is high. He introduces the concept of technical buy points. These are not guesses but defined entry levels based on chart patterns, such as a breakout above the handle of a cup and handle, a high tight flag, or other consolidation patterns. Each pattern has an ideal range where probability favors upward movement. Traders who stick to these points avoid emotional decisions that often lead to premature entries. Volume confirmation is a key component of timing. Mark emphasizes that a strong breakout should be accompanied by rising volume. Low volume breakouts often fail, while moves supported by institutional buying have a higher chance of success. Watching the market context is also essential. Is the overall market trending upward, sideways, or declining? Aligning the trade with market momentum increases the probability of sustained gains. Risk management is closely tied to entry timing. By entering at the proper buy point, a trader can place a tight stop loss just below the base. This limits downside while giving the stock room to move. The combination of precise entry and controlled risk creates an optimal reward-to-risk ratio. Champions rarely take trades without knowing exactly how much they can lose. Mark also emphasizes tactical patience. Not every setup should be traded immediately. Sometimes a stock tests its base or hesitates at resistance before breaking out. Champions wait for confirmation. They may use pullbacks or retests as safer entry points, rather than chasing the stock upward. Impatience often leads to entering too early, increasing risk and lowering potential reward. Another critical aspect is position sizing at entry. Even when the buy point is perfect, the size of the position determines the real risk. Entering with a smaller position initially allows flexibility to add as the trade confirms its strength. Pyramiding into winners is covered in later chapters, but the initial entry must always reflect discipline and controlled risk. Mark warns against emotional entry tactics, such as buying after a stock has already surged. Chasing momentum can lead to buying at inflated prices and exposing the trade to sudden reversals. Instead, SEPA-based entry points combined with patience and volume confirmation provide a structured method that minimizes emotional influence. Finally, Mark links timing to overall strategy. Knowing when to enter is useless without a plan for exit, risk control, and position management. Entry timing is just one component of a disciplined trading process that turns preparation, mindset, and strategy into consistent results. Once traders master precise entry points, the next challenge is managing risk and calculating potential losses mathematically. Without risk control, even perfect timing and strong setups can destroy a portfolio. That critical skill is explored in the next chapter. Chapter 9. Managing Risk. The Mathematics of Losing. No matter how strong a stock looks, every trade carries risk. Mark Minervini emphasizes that managing risk is not optional. It is the foundation of consistent trading success. Even the best setups can fail, and losing trades are inevitable. The key is to control losses so that one bad trade does not wipe out weeks or months of profits. This is the mathematics of losing, understanding and limiting risk to preserve capital while letting winners run. Mark begins by explaining that risk is not simply about price movement. It is the difference between the entry point and the stop-loss level multiplied by the position size. By calculating risk before entering a trader knows exactly how much they can lose. This clarity removes emotion and allows decisions to be made objectively. Discipline in defining risk is what separates professionals from amateurs who often gamble with their capital. He highlights the importance of position sizing. Even when a stock meets all criteria for a high-probability trade, taking too large a position can magnify losses beyond what the trader can tolerate. Proper sizing ensures that no single trade can damage overall performance. Champions determine the size of each trade based on their account, risk tolerance, and the distance to the stop-loss. By limiting exposure, they survive the inevitable setbacks. Mark also explains that losing is not a failure, but part of the process. Every trader experiences losses, but consistent winners view them as learning opportunities rather than disasters. Understanding the probability of losing and preparing for it mentally allows a trader to act calmly. The mathematics of losing is about knowing how much is at stake, accepting it, and having a plan in place. Stop-loss placement is another critical element. Mark teaches that stops should be set logically, not emotionally. They are placed at levels where a trade no longer aligns with the original thesis. Emotional stops, placed too close or too far, invite failure. Proper stops control risk while giving the stock room to move within normal fluctuations. He introduces the concept of reward-to-risk ratio. Every trade should offer potential gains that significantly outweigh potential losses. This ratio ensures that even if only a portion of trades succeed, the overall portfolio can remain profitable. Champions focus on trades where the upside is several times greater than the defined risk, tilting the odds in their favor. Mark also emphasizes diversification and portfolio risk management. Risk is not only about individual trades, but also about exposure across sectors, positions, and market conditions. Overconcentration in one stock or sector can create catastrophic losses. Professional traders manage both trade-specific and overall portfolio risk to survive volatility and drawdowns. Psychology is tightly linked to risk management. Many traders violate stops out of hope or fear, turning controlled risk into catastrophic loss. Champions follow their plan strictly. They understand that cutting losses quickly is not failure, but a disciplined approach to survival and long-term profitability. Finally, Mark reminds that mastering risk management builds confidence. When you know exactly how much you can lose, you can take trades with clarity and focus. Risk control transforms trading from gambling into a performance sport, where probabilities are calculated, losses are contained, and winners are maximized. Once a trader masters risk, the next step is learning to navigate the volatility of the market while keeping losses tight. Volatility tests discipline and execution, and handling it properly is the subject of the next chapter. Chapter 10: How to Handle Volatility and Tight Risk Control. Markets are unpredictable. Price swings, sudden news, and unexpected events create volatility, which can be intimidating for traders. Mark Minervini emphasizes that volatility is not the enemy. It is simply part of the market environment. The challenge is to handle it effectively while keeping losses tightly controlled. Champions thrive in volatility because they prepare, plan, and act with discipline. Mark begins by explaining the difference between normal fluctuations and disruptive volatility. Stocks move up and down within a normal range, and this is expected. The real challenge comes when price swings exceed typical patterns, often triggered by news, rumors, or broader market moves. Traders who panic or overreact during these periods increase their risk. The goal is to respond with logic, not emotion. He introduces the principle of tight risk control. The key is defining the maximum acceptable loss for each trade before entering. This involves setting stop-loss levels and adjusting position size accordingly. By doing this, even sudden volatility cannot destroy capital. Tight risk control acts as a protective shield, allowing traders to stay in the game and take advantage of opportunities without fear. Mark also emphasizes scaling into trades. Instead of committing the full position at once, traders can enter gradually as confirmation signals appear. This approach reduces exposure during volatile periods while allowing participation in strong trends. Champions use this tactic to balance risk and opportunity, ensuring they remain flexible and protected. Another crucial concept is mental preparation for volatility. Many traders lose focus when the market moves sharply. Fear and greed dominate decisions, leading to impulsive buying or premature selling. Champions anticipate volatility as part of every trade. They maintain emotional neutrality, sticking to the plan regardless of short-term price swings. This mindset allows them to see opportunity where others see chaos. Mark highlights the importance of monitoring key levels. Support, resistance, and breakout points guide traders in volatile conditions. By watching these levels, traders can adjust stops, take partial profits, or wait for confirmation before adding to positions. Precision in action ensures that volatility does not translate into unnecessary risk. He also discusses the role of market context. Even a strong stock can struggle if the overall market is weak or unstable. Champions align their trades with broader trends, avoiding positions that are high risk due to adverse market conditions. Understanding context allows for better decision-making during turbulent periods. Position sizing is again emphasized in volatile markets. Smaller initial positions reduce exposure, while the stock's behavior confirms strength. As the trade progresses and volatility stabilizes, positions can be increased strategically. This approach minimizes losses while maximizing upside potential. Finally, Mark reinforces the psychological advantage of tight risk control. When a trader knows losses are contained, confidence grows. Emotional pressure decreases, and decision-making becomes clear and objective. Volatility then becomes an opportunity, not a threat. Champions embrace price swings, understanding that disciplined execution and risk management transform uncertainty into a competitive edge. By mastering volatility and maintaining tight control over losses, a trader gains the ability to navigate any market environment. With these principles in place, the focus can now shift to advanced strategies for identifying exceptional opportunities. The next chapter explores the 5 key elements of SEPA, which refine entry, risk, and timing into a precise and repeatable method. Part 3: Advanced Concepts and Execution. With a strong mindset, disciplined process, and precise risk management in place, traders are ready to take their skills to the next level. Part 3 focuses on advanced concepts and execution, the techniques that separate good traders from champions. Mark Minervini emphasizes that mastery in trading comes not only from understanding the basics, but also from applying sophisticated strategies, identifying exceptional opportunities, and executing with precision. In this part, the focus shifts from preparation and entry to refining execution. You have learned how to prepare, manage risk, and enter trades with confidence. Now, the goal is to optimize performance by understanding advanced patterns, position sizing, pyramiding, and selling strategies. These are the tools that allow traders to extract maximum potential from every high-probability setup. Mark introduces the idea that trading at a higher level requires attention to nuance. Small differences in timing, position size, or pattern recognition can dramatically affect results. Champions study these details, learn to anticipate market behavior, and execute trades with exacting precision. This combination of analysis, strategy, and disciplined action produces extraordinary outcomes over time. This section also emphasizes superperformance stocks, rare opportunities that can deliver outsized gains. Identifying these stocks requires a deep understanding of both technical patterns and fundamental strength. Champions do not waste capital on average opportunities. They focus on trades where probability, timing, and momentum align to create exceptional potential. Part 3 bridges the gap between structured trading and mastery. It teaches traders how to combine the principles of SEPA, risk management, and market psychology with advanced techniques that allow for consistent, superior performance. Precision, patience, and disciplined execution are the hallmarks of this stage. With these concepts, the trader is ready to explore the first advanced technique. The 5 key elements of SEPA, which provide a framework for identifying precise entry points, managing risk, and executing trades with confidence. Chapter 11. The 5 key elements of SEPA. The SEPA strategy is the cornerstone of Mark Minervini's trading methodology, but mastery comes from understanding its 5 key elements. These elements provide a structured, repeatable approach to finding high-probability trades while controlling risk. SEPA is not a vague guideline. It is a precise system that champions use to execute trades consistently and profitably. The first element is stock selection. Not every stock qualifies as a SEPA candidate. Champions focus on companies with strong fundamentals, leadership in their industry, and consistent earnings growth. The goal is to identify stocks with the potential for significant upside. Technical strength must align with these fundamentals, ensuring that the trade has both momentum and underlying value. The second element is base formation. A stock must consolidate after a prior move, forming a stable foundation for the next advance. Bases can take different forms, such as flat bases, cup and handle patterns, or tight consolidations. Mark emphasizes that the quality of the base matters. The tighter and cleaner the base, the lower the risk and the higher the probability of a successful breakout. The third element is volatility contraction. As a stock tightens within its base, selling pressure decreases, while institutional accumulation often occurs quietly. This contraction signals that the stock is preparing for a powerful move. Champions watch for subtle signs, such as decreasing swings in price and narrowing trading ranges, to identify the optimal moment for entry. The fourth element is volume confirmation. A breakout without volume is unreliable. SEPA requires that rising prices be supported by increased volume, indicating that the market participants are committed. Rising volume shows strength, validates the pattern, and increases the probability of sustained gains. Mark teaches traders to pay close attention to this signal as a key confirmation before committing capital. The fifth element is risk control and stop placement. Even the perfect setup can fail, so it is crucial to define maximum acceptable losses. SEPA emphasizes placing stop-loss orders below the base or key support levels, ensuring that risk is limited. Tight, logical stops protect capital while giving the stock room to move naturally. Risk management is not optional. It is an integral part of the SEPA framework. Mark emphasizes that the power of SEPA lies in combining these 5 elements. Each element reinforces the others, creating a system that is precise, repeatable, and objective. When all 5 align, the probability of success is maximized, and the trader can act with confidence. He also notes that discipline is essential. Following the SEPA criteria strictly requires patience and emotional control. Impulsive decisions, chasing hot stocks, or ignoring risk parameters can quickly turn a high-probability setup into a costly mistake. Champions maintain fidelity to the system, executing trades only when all 5 elements are present. Finally, Mark connects SEPA to overall strategy. By consistently applying the 5 key elements, traders develop a mental edge and a practical framework for action. The methodology turns preparation, analysis, and observation into precise execution, allowing traders to perform like champions. With the SEPA elements understood, the next focus is identifying superperformance stocks, the rare opportunities that can deliver extraordinary gains. These stocks combine technical and fundamental strength, and recognizing them is the next step in advanced trading mastery. Chapter 12. Identifying Superperformance Stocks. Not all stocks move the same. Some barely inch higher over months, while others surge dramatically, delivering outsized returns. Mark Minervini calls these rare opportunities superperformance stocks. Identifying them is a crucial skill for traders seeking to maximize gains, and it requires combining technical patterns, fundamentals, and market context. Champions focus on these high-potential stocks because they provide the best reward-to-risk ratio. Mark begins by defining the characteristics of superperformance stocks. First, they show strong fundamentals. This includes consistent earnings growth, increasing revenue, and leadership within their industry. Strong fundamentals indicate that the company is healthy and capable of sustaining upward price movement. Champions do not rely solely on charts. They look for stocks with real economic strength behind the technical signals. Second, superperformance stocks exhibit technical strength. This includes chart patterns like tight bases, high tight flags, and clear breakouts. Price action should show higher lows, rising momentum, and a consolidation that tightens volatility. The combination of technical and fundamental strength is what differentiates ordinary stocks from those with the potential for exceptional moves. Third, the stock should be in an optimal market context. Even the strongest individual stock can struggle if the broader market is weak or declining. Champions align their trades with overall market trends, sectors that are performing well, and stocks that are leading their peers. Context matters because it increases the probability that a strong stock will continue its upward trajectory. Mark emphasizes price relative strength as a key indicator. Superperformance stocks consistently outperform the market and their industry peers. Traders look for stocks climbing while most others stagnate. This relative strength signals accumulation by institutional investors, increases the likelihood of continued upward movement, and provides a signal for potential entry using SEPA. Another hallmark is tight consolidation. Before a big move, a superperformance stock often contracts into a narrow range, reducing volatility. This signals that selling pressure is exhausted and the stock is ready for the next leg higher. Volume patterns confirm accumulation. A stock moving higher on increasing volume after a tight base is a classic marker of superperformance potential. Risk management is tightly integrated. Even with high potential, these stocks can fail or retrace. SEPA rules, proper stop-loss placement, and position sizing ensure that a trader's downside is protected. Champions understand that the focus is on probability and capital preservation, not on guessing the absolute top or bottom. Mark also highlights the psychological aspect. Superperformance stocks can experience sharp pullbacks or volatile swings. Many traders panic during minor setbacks and exit early. Champions remain patient, trust the plan, and add to positions strategically as momentum confirms strength. Emotional control is critical when managing high-potential stocks. Finally, he stresses that identifying superperformance stocks is not random. It is a repeatable process that combines fundamental research, chart analysis, relative strength evaluation, and SEPA-based entry points. The trader who masters this approach focuses on quality over quantity, limiting trades to the highest probability opportunities. With the ability to identify superperformance stocks, traders are ready to apply the volatility contraction pattern, an advanced technical setup that often precedes explosive moves. This concept refines the entry process and is explored in the next chapter, the Volatility Contraction Pattern, VCP. Chapter 13, the Volatility Contraction Pattern, VCP. The Volatility Contraction Pattern, or VCP, is one of Mark Minervini's most powerful tools for identifying potential breakout stocks. It is a technical pattern that signals a stock is preparing for a strong move. Champions use VCP to enter trades at precise moments, minimizing risk while positioning for maximum gains. Understanding and recognizing this pattern is essential for advanced trading success. Mark begins by explaining the principle behind VCP. A stock in a strong uptrend often undergoes periods of consolidation. During these phases, price swings gradually narrow, forming tighter ranges. This contraction indicates that sellers are losing control and that buying pressure is quietly accumulating. As the stock tightens, the potential for a sharp, explosive move increases. The pattern consists of a series of successively smaller price swings, or contractions, within a base. Each contraction reduces volatility, signaling diminishing risk and increasing the probability of a breakout. Champions watch for 3 or more contractions that demonstrate the stock's ability to absorb selling pressure while maintaining technical strength. Volume plays a critical role in VCP. During contractions, volume typically decreases, reflecting reduced selling activity. On the breakout, volume should increase significantly, confirming institutional interest and validating the pattern. This combination of tightening price action and volume expansion provides a high probability setup. Mark emphasizes patience. VCP setups require waiting for the pattern to fully develop. Impulsive traders often enter too early, before the stock has completed its contractions, increasing risk and reducing reward potential. Champions wait until the final contraction is complete and the breakout is confirmed, ensuring the highest probability entry point. Another key aspect of VCP is risk control. Because the pattern contracts tightly, traders can place stops very close to the base, minimizing potential losses. This tight risk combined with significant upside potential creates a highly favorable reward-to-risk ratio. Mark stresses that this disciplined approach allows traders to participate in strong moves without jeopardizing capital. Mark also discusses pattern integrity. Not all contractions are valid. Superficial patterns or irregular swings do not provide the same statistical advantage. Champions look for clean, orderly contractions where each subsequent range is smaller than the previous one. This clarity ensures that the setup is reliable and reduces the likelihood of false breakouts. Psychology is intertwined with the VCP. Many traders feel anxiety during contractions because the stock appears dormant or moves sideways. Champions understand that this period is essential preparation for a powerful move. Trusting the process and maintaining discipline during consolidation is crucial for successful execution. Finally, VCP is not a standalone tool. It complements the SEPA strategy and other advanced trading concepts. It allows traders to identify high probability entries, confirm institutional support through volume, and manage risk effectively. By mastering the VCP, traders refine their ability to enter superperformance stocks at optimal points, combining technical precision with disciplined execution. Once the VCP setup is understood and applied, the next step is managing trades through position sizing and pyramiding, ensuring that winners are maximized while risk remains controlled. This concept is the focus of the next chapter. Chapter 14: Position Sizing and Pyramiding. Entering a trade is only the beginning. Managing it effectively determines whether it becomes a small win or a significant profit. Mark Minervini emphasizes that position sizing and pyramiding are essential tools for maximizing gains while controlling risk. Champions do not treat all trades equally. They allocate capital strategically, adjusting exposure based on probability, momentum, and confirmation of strength. The first principle is initial position sizing. Even when a stock meets all SEPA criteria, it is important to start with a controlled amount of capital. The initial size is calculated based on risk tolerance and the distance to the stop loss. By limiting the initial risk, traders protect their portfolio from unexpected setbacks while remaining positioned to benefit from potential upside. Mark introduces pyramiding, a method for adding to positions as the trade proves itself. When a stock moves in the desired direction and confirms strength, additional shares can be purchased in stages. Each addition is smaller than the previous one, maintaining overall risk control. Pyramiding allows champions to participate in large moves without overexposing themselves early in the trade. He emphasizes discipline in scaling. Adding too aggressively or too soon increases risk and can turn a winning trade into a loss. Conversely, waiting for confirmation before adding ensures that only the strongest setups are expanded. Champions follow precise rules for pyramiding, combining technical signals, price behavior, and volume confirmation to guide each incremental increase. Risk control is integral to both initial sizing and pyramiding. Each layer added must have its own stop loss, calculated independently to maintain the portfolio's overall safety. This systematic approach allows the trade to grow, while ensuring that a reversal does not result in catastrophic loss. Mark stresses that pyramiding is not about guessing the top, but about enhancing profits while controlling exposure. Another key principle is reward to risk assessment. Every additional layer should offer a favorable balance of potential reward compared to defined risk. If the stock fails to move as expected, the trader exits at predetermined levels. By maintaining this discipline, even trades that do not reach full potential remain profitable or minimally damaging. Psychology is also critical in position management. Many traders fear missing out and add too quickly, or they panic and fail to add at all. Champions remain objective, focusing on the signals rather than emotions. Trusting the process and letting the stock prove itself before increasing exposure is the hallmark of advanced execution. Mark also notes that pyramiding works best with superperformance stocks and strong VCP setups. These stocks have the momentum, volume support, and technical structure to allow multiple additions without excessive risk. Combining SEPA, VCP, and disciplined pyramiding creates a powerful framework for maximizing profits. Finally, he emphasizes that position sizing and pyramiding are dynamic. Traders continuously assess market conditions, stock behavior, and risk exposure. Adjustments are made logically, never emotionally. The goal is to extract maximum gains from high-probability trades while preserving capital for future opportunities. With position sizing and pyramiding mastered, the next critical skill is knowing when to sell, whether taking profits on strength or cutting losses when a trade fails. Proper exit strategy is the final piece of execution and is explored in the next chapter. Chapter 15. Selling into strength and cutting losses. Knowing when to exit a trade is as important as knowing when to enter. Mark Minervini emphasizes that selling is a deliberate, strategic action, not an emotional reaction. Champions maximize profits by selling into strength and minimize losses by cutting trades that fail to perform. Mastery of exits ensures long-term success and preserves capital for future opportunities. The first principle is selling into strength. Stocks that move rapidly can continue to climb, but there are moments when taking partial profits makes sense. Champions sell small portions of their position when the stock reaches predefined targets or shows signs of slowing momentum. This allows traders to lock in gains while maintaining exposure to the remaining potential upside. Partial exits reduce emotional pressure and prevent the temptation to exit completely too early. Mark also highlights the importance of observation and adaptability. Selling is not based solely on price targets. Traders must watch for changes in volume, price behavior, and market context. If a stock shows signs of weakening, such as declining volume, widening swings, or a break in technical structure, it may be time to exit fully or adjust the position. Champions remain flexible and objective, responding to market behavior rather than wishful thinking. Cutting losses is equally critical. No trade is guaranteed, and even perfect setups can fail. Mark stresses that a defined stop loss is essential before entering any trade. Cutting losses quickly prevents small mistakes from becoming catastrophic. Emotional hesitation often leads to holding onto losing trades, turning a controlled risk into a major setback. Champions accept losses as part of the game and act decisively. He introduces the concept of trailing stops as a tool for both profit protection and loss management. A trailing stop moves with the stock as it rises, allowing traders to ride winners while automatically locking in gains. If the stock reverses sharply, the trailing stop triggers, ensuring that profits are captured without requiring constant monitoring or emotional decision-making. Mark emphasizes the balance between patience and discipline. Exiting too early can limit profits, while holding too long can erode gains. Champions follow a system that combines technical rules, momentum analysis, and risk parameters to determine when to take action. Consistency in following these rules compounds results over time. Psychology plays a significant role in selling. Many traders fear missing out on further gains and hesitate to take profits. Others cling to losing positions in the hope they will recover. Champions manage emotions by relying on predefined plans, technical confirmations, and disciplined execution. Emotional neutrality ensures that decisions are rational rather than reactive. He also stresses that selling is part of the broader trading process. Entry, position sizing, pyramiding, and exits are interconnected. A trade is never complete until profits are secured or losses are contained. Champions think in terms of complete trades, not just individual actions. Finally, Mark reminds traders that mastering exits allows them to focus on the next opportunity. By selling into strength and cutting losses promptly, capital is preserved and freed for high-probability trades. Exits, like entries, require preparation, rules, and emotional control. Proper execution at this stage turns potential gains into actual profits and completes the cycle of disciplined trading. With exits fully understood, traders are ready to focus on the inner game, discipline, patience, and the mental habits that sustain consistent performance. This is the focus of Part 4. Part 4. Mastering the Inner Game. Trading is not only about strategies, patterns, and technical skills. True mastery comes from the inner game, the mindset, discipline, and emotional control that allow a trader to perform consistently under pressure. Part 4 focuses on developing these qualities, which distinguish champions from average traders. Mark Minervini emphasizes that without mental strength, even the best strategies can fail. In this part, the focus shifts from mechanics and execution to psychology and habits. Traders will learn how to maintain discipline during volatile markets, handle drawdowns without panic, and develop routines that reinforce consistency. Champions understand that their mind is the ultimate tool in the market, and controlling it is just as important as analyzing charts or executing trades. Mark introduces the idea that discipline, patience, and persistence are the foundations of the inner game. These qualities ensure that trades are executed according to plan, losses are contained, and profits are maximized. Emotional reactions such as fear, greed, or impatience are the biggest obstacles to long-term success, and Part 4 teaches traders how to overcome them. This section also emphasizes preparation and routine. Champions develop daily habits that support mental clarity, focus, and readiness. These routines ensure that traders approach each session with confidence, stay alert to opportunities, and act decisively when conditions align. With the principles of the inner game understood, the next chapter explores discipline and patience, the core traits that provide traders with a competitive edge and the ability to consistently execute winning strategies. Chapter 16. Discipline and Patience. The Trader's Edge. Discipline and patience are the cornerstones of trading success. Mark Minervini emphasizes that technical skills and strategies alone cannot create consistent winners. Without the ability to follow a plan, control emotions, and wait for the right opportunities, even the best setups fail. Champions cultivate discipline and patience as their ultimate edge in the market. Discipline begins with following your rules. Every trader has a plan: entry points, stop-loss levels, position sizing, and exit strategies. Mark stresses that adhering to these rules consistently separates professionals from amateurs. Emotional impulses such as fear or greed often cause traders to deviate, leading to losses. Champions, however, execute their trades exactly as planned, regardless of short-term market fluctuations or psychological pressure. Patience is equally essential. Many traders enter trades too early, chasing potential winners or fearing missing out. SEPA, VCP, and other advanced setups require waiting for precise conditions to align. Mark explains that missing a trade is far better than entering prematurely. Champions understand that patience is not passive. It is an active strategy of waiting for probability to favor them. Mark also highlights the role of self-control under volatility. Markets often test patience with sudden swings or rapid price movements. A disciplined trader does not panic or overreact. They remain focused on the setup and maintain risk parameters, trusting that the plan will work if applied correctly. Emotional neutrality is the key to thriving in chaotic environments. Another important aspect is learning from experience without emotional attachment. Losses and setbacks are inevitable, but disciplined traders analyze them objectively. They do not allow mistakes to erode confidence or trigger revenge trading. Instead, they integrate lessons into their process, improving execution and decision-making over time. Patience allows the trader to see patterns develop fully and to act only when the highest probability opportunity appears. Mark stresses that discipline and patience extend beyond individual trades. Champions maintain consistency across every aspect of their trading life: preparation, analysis, execution, and review. Habits of routine, focus, and emotional control compound over time, creating a sustainable advantage. He also emphasizes that the psychological edge gained from discipline and patience enhances confidence. When a trader knows they can wait for the right setup and execute flawlessly, fear and doubt diminish. Confidence grows not from ego, but from repeated success in following a proven system. Finally, Mark links discipline and patience to long-term performance. Traders who master these traits can withstand drawdowns, maintain proper risk control, and take advantage of superperformance opportunities without emotional interference. The mental edge allows them to consistently outperform those who rely solely on skill or intuition. With discipline and patience established, the next challenge is learning how to handle drawdowns and setbacks. Managing losing periods without losing focus is critical for long-term success, and this is the subject of the next chapter. Chapter 17. Dealing with Drawdowns and Setbacks. Every trader faces losing periods. No strategy, no matter how precise, is immune to losses. Mark Minervini emphasizes that drawdowns and setbacks are part of the trading journey. What separates champions from average traders is not the absence of losses, but how they respond to them. Managing setbacks effectively is essential for long-term success and mental stability. Drawdowns are defined periods when a trader's account value declines from a peak. These can occur due to market volatility, a series of losing trades, or temporary weakness in a strong stock. Mark stresses that drawdowns are inevitable, and anticipating them mentally reduces emotional stress. Traders who understand this are less likely to panic, overtrade, or deviate from their rules. One key strategy is acceptance and objectivity. Losses are not personal failures. They are the cost of doing business in trading. Champions treat losing trades as information, analyzing what went wrong without emotional attachment. They ask whether the rules were followed, whether risk was properly managed, and what can be learned for future trades. This approach turns setbacks into learning opportunities. Mark highlights risk management as a buffer against drawdowns. Proper position sizing, tight stops, and disciplined entry points limit the impact of losing trades. By controlling risk on every trade, traders ensure that a drawdown does not threaten their ability to continue trading. This disciplined approach preserves capital and maintains confidence during difficult periods. Emotional control is critical. Drawdowns often trigger fear, frustration, or overconfidence. Many traders abandon their plan, chase losses, or take unnecessary risks to recover quickly. Champions remain calm, sticking to their process and avoiding impulsive decisions. Patience and discipline are reinforced during drawdowns, strengthening the inner game. Mark also emphasizes maintaining perspective. Short-term setbacks do not define long-term performance. By focusing on process rather than outcomes, traders keep their attention on high-probability setups rather than being distracted by temporary losses. This mindset prevents emotional erosion and allows consistent execution over time. Another key point is resilience through preparation. Traders who have thoroughly studied patterns, rules, and risk controls are less affected by setbacks. Knowledge and experience provide confidence that the system works, even if individual trades fail. Champions trust their preparation and continue to execute their plan with discipline. Mark discusses recovery strategies. After a drawdown, it is important to remain patient, avoid revenge trading, and gradually rebuild positions according to the rules. Incremental recovery preserves mental clarity and ensures that gains are not achieved at the expense of risk control. Each step back into trading should be deliberate and disciplined. Finally, he emphasizes that handling drawdowns and setbacks strengthens the inner game. Traders who respond calmly, learn from mistakes, and maintain their process develop resilience, patience, and confidence. These qualities are the foundation for consistent performance and allow champions to thrive even in challenging market conditions. With the ability to handle setbacks firmly in place, the next chapter focuses on establishing the champion's routine. daily habits and practices that reinforce preparation, practice, and persistence, ensuring long-term success in the markets. Chapter 18. The Champion's Routine: Preparation, Practice, Persistence. Success in trading is not accidental. Mark Minervini emphasizes that champions develop a routine that combines preparation, practice, and persistence. This daily discipline reinforces mental strength, ensures consistent execution, and allows traders to stay ahead of the market. Trading is a performance sport, and like any elite athlete, a structured routine is essential for peak performance. The first pillar is preparation. Champions begin each day by analyzing the market, reviewing positions, and identifying potential trades. They study charts, monitor sector strength, and watch for news that may influence stock behavior. Preparation reduces surprises, sharpens focus, and allows traders to enter the market with clarity. Mark stresses that preparation is not casual. It is deliberate and systematic, forming the foundation of consistent execution. The second pillar is practice. Like any skill, trading improves through repetition and refinement. Champions review past trades, evaluate successes and failures, and simulate potential setups. By practicing decision-making under controlled conditions, traders strengthen their ability to act swiftly and accurately during real-time market moves. Practice also involves testing strategies, refining techniques, and learning to recognize patterns quickly and accurately. Persistence is the third pillar. Markets are unpredictable, and losses are inevitable. Champions persist through drawdowns, setbacks, and periods of frustration. They remain committed to their system, patiently waiting for high-probability setups and executing trades according to their rules. Persistence ensures that short-term challenges do not derail long-term success. Mark emphasizes that consistent effort, even during periods of uncertainty, compounds over time into exceptional performance. Mark also highlights mental preparation as part of the routine. Champions start each day with focus and emotional clarity, ensuring that fear, greed, or impatience do not influence decisions. Mindset exercises, visualization, and reflection on rules and goals help traders maintain discipline and stay in control under pressure. Mental preparation allows traders to respond objectively to opportunities and challenges. Another critical aspect of the champion's routine is review and reflection. At the end of each trading day, traders evaluate every action. They ask what worked, what did not, and how to improve. This reflective practice transforms mistakes into lessons and strengthens the trader's decision-making process. Champions learn faster because they systematically analyze experience rather than relying on intuition alone. Mark emphasizes that the champion's routine also involves physical and emotional well-being. Adequate sleep, exercise, and stress management are essential for maintaining focus and discipline. Trading requires sustained attention, and a healthy body and mind support consistent execution. Neglecting these areas increases the likelihood of errors and emotional reactions. Finally, Mark ties the routine back to consistent performance. Preparation ensures readiness, practice builds skill, and persistence reinforces discipline. Together, these habits create an environment where the trader can execute the SEPA strategy, manage risk, and act with precision. The champion's routine transforms potential into consistent results. With a strong routine in place, traders are ready to focus on becoming consistently profitable, integrating mindset, strategy, and execution to achieve sustained success. This is the subject of the next chapter. Chapter 19. Becoming a consistently profitable trader. Profitability is the ultimate goal of trading, but consistent profits require more than luck or talent. Mark Minervini emphasizes that becoming consistently profitable comes from the integration of mindset, process, and execution. Champions do not rely on guessing. They rely on a disciplined system that combines preparation, analysis, risk management, and emotional control. The first key to consistency is following a proven methodology. Systems like SEPA, VCP, and advanced position management are designed to give a trader an edge. By applying these tools systematically, traders increase the probability of success. Mark stresses that consistency comes from execution, not from trying to predict the market or chase random opportunities. Each trade must adhere to established criteria. Second, risk management ensures that no single trade can threaten overall profitability. Consistently profitable traders calculate potential loss before entering a position, place logical stop losses, and size positions to control exposure. By limiting losses, they ensure that setbacks do not erode gains. This approach transforms trading into a performance sport, where probabilities are stacked in the trader's favor over time. Psychology and emotional control are equally important. Many traders lose consistency due to fear, greed, or frustration. Champions maintain objectivity, following their plan regardless of market noise. They accept that losses are part of the process and focus on the long-term goal. Emotional discipline allows them to execute trades cleanly, avoid impulsive decisions, and capitalize on high-probability opportunities. Mark also emphasizes continuous learning and adaptation. Markets evolve, and traders must adapt strategies while maintaining core principles. Consistently profitable traders review trades, analyze mistakes, and refine their approach. They treat every setback as a learning opportunity and every success as confirmation of sound methodology. Over time, this iterative process strengthens both skills and confidence. Another critical factor is trade selection. Champions do not trade frequently. They trade selectively. They focus on setups with high probability, such as Superperformance stocks or VCP patterns, avoiding mediocre or low potential opportunities. By concentrating on quality trades rather than quantity, they maximize gains while minimizing unnecessary exposure. Mark stresses the importance of patience. Consistent profitability requires waiting for optimal setups and avoiding impulsive trades. Missing a trade is far better than entering prematurely. By being selective and disciplined, traders ensure that each trade has a favorable reward-to-risk ratio, reinforcing long-term gains. Finally, record-keeping and performance review are essential. Profitable traders track every trade, analyzing what went right and wrong. This systematic review ensures that lessons are learned, adjustments are made, and habits are reinforced. Consistency is not accidental. It is the result of deliberate practice, disciplined execution, and continuous improvement. By integrating methodology, risk control, emotional discipline, selective trade entry, and continuous learning, traders develop the ability to produce reliable, repeatable profits over time. Mastering consistency lays the foundation for the final principles of trading, the mindset, creed, and habits that define a true champion. This leads directly to the next chapter. Chapter 20, The Champion's Creed. The final chapter of Mark Minervini's framework focuses on the Champion's Creed, a set of principles and mental habits that define elite traders. Beyond technical skills, strategies, and risk management, it is the champion's mindset that ensures long-term success. This creed is not a list of rules. It is a philosophy that guides every decision, action, and reaction in the market. The first principle of the creed is commitment to discipline. Champions follow their rules without compromise. Entries, exits, position sizing, and risk parameters are executed consistently. Discipline is not about rigidity. It is about reliability, ensuring that each trade is approached logically rather than emotionally. By committing fully to the system, traders align their actions with probability and control. Second, patience and timing are fundamental. The market rarely offers perfect opportunities, and champions wait for setups that meet all criteria. They understand that impatience leads to suboptimal trades, higher risk, and lost profits. By practicing patience, they enter trades with the highest probability of success, maximizing potential while minimizing risk. The third principle is respect for risk. Every trade involves uncertainty, and champions never ignore potential loss. They size positions logically, place stops strategically, and manage exposure carefully. Respecting risk ensures that setbacks are controlled, allowing the trader to survive and thrive over the long term. This mindset transforms fear into calculated caution rather than paralysis or impulsive reaction. Fourth, the creed emphasizes continuous learning and self-improvement. Markets evolve, and champions evolve with them. They review past trades, analyze mistakes objectively, and refine strategies. Learning is not optional. It is a daily practice that strengthens both skill and confidence. Champions view every trade, win or lose, as a source of knowledge to enhance future performance. Fifth, mental clarity and emotional control are central. Champions maintain focus under pressure, avoiding fear, greed, or frustration. Emotional neutrality allows them to act decisively when opportunities arise and to exit trades without hesitation. The mind becomes a tool of precision, guiding actions based on rules and probability rather than reaction. Mark also stresses resilience and persistence. Even during drawdowns or unexpected market swings, champions persist in their system. They maintain routines, follow strategies, and avoid impulsive decisions. Resilience ensures that short-term setbacks do not compromise long-term success, allowing the trader to remain consistent and confident. Another critical element is integrity and responsibility. Champions take ownership of every decision. Successes are celebrated as the result of preparation and execution, and losses are analyzed without blame or excuse. This accountability reinforces learning, strengthens discipline, and builds a mindset of continuous improvement. Finally, the champion's creed is about vision and purpose. Traders who adhere to this philosophy understand why they trade, not just for profit, but to master a discipline, to challenge themselves, and to apply knowledge with precision. This clarity of purpose aligns every decision with long-term goals, ensuring that every trade, routine, and habit supports consistent growth. By embodying these principles, traders integrate mindset, strategy, and execution into a cohesive whole. The creed transforms a technically skilled trader into a true champion, capable of performing consistently under pressure, capitalizing on high-probability setups, and achieving sustainable success. Mastery of the inner game, combined with disciplined execution and advanced strategies, completes the journey from aspiring trader to champion in the market. If you found this summary helpful, subscribe,